Hey, what's up guys? It's Jonathan here. Becoming an investor can be one of the most life-changing events that could ever happen to you. Once you realize you don't have to trade your time for money, it completely changes your outlook on life in general. But amongst all investors, there are some very common mistakes that all investors make. From the investor that just started investing recently to the one that has been investing for many years. So in this video, we'll discuss 8 common investment mistakes that all investors should avoid, and some tips on how to avoid making these mistakes yourself. So if this video provides you any value, please consider hitting the like and subscribe button. It greatly helps the channel grow and helps push this video out to as many people as possible. So let's get right into the video. The first investment mistake you should always avoid is panic selling. And pretty much what panic selling is when you sell an asset after it significantly has dropped in value over a short period of time. So usually what happens is that someone will see that their stock or their asset fell significantly in value over a short period of time. And because they're afraid that they may lose more money, they decide to sell immediately. And most of the time you see panic selling, it usually happens in either the stock market or in the crypto market. And you almost never see it in real estate because in real estate, it's almost impossible to panic sell, as it could take you a month, if not longer, to liquidate real estate. Even though you may think that this is a rookie mistake, there's even experienced investors that do this as well. Even someone like me who's been buying and selling stocks for years now makes this mistake as well. So just recently there was a day where the entire market was selling off and the S&P 500 sold off about 1.5% that day. So for me, I like to keep all my cash in an S&P 500 index fund while I look for opportunities to put that money into individual stocks. For every reason that day, I panic sold and I completely sold out of my position of that index fund. And if I have a screenshot of it, I'll put it up on the screen here. And just my luck, the very next day, that index fund decided to shoot up 4%. And when I decided to sell that day, I forgot to ask myself the most important question. And that question is, has the fundamentals of what I'm investing in changed? As an investor who's thinking in the long term versus a trader who's thinking in the short term, or a swing trader who's thinking in the medium term, the day-to-day movement of a stock price shouldn't matter to you. But instead, the fundamentals should be the thing that guides your investment decisions. As in the long run, it's the fundamentals that guide the stock price and not the day-to-day movement of the stock. So anytime you're thinking about selling, always ask yourself that question. Have the fundamentals of this investment changed? The second mistake that every investor should avoid is buying the hype. And when I say buying the hype, I mean buying stocks that have ran up a significant amount over a relatively short period of time. Most of the time, these movements are momentum driven. And in some cases, when investors see the price of a stock like this run in, they'll get the feeling of FOMO or the fear of missing out. And they'll buy in at nosebleed prices just so they don't get left behind. But in most cases, usually what ends up happening is they end up buying at the top or somewhere near the top. Then the stock will start to correct back to its previous price before it started running. This ends up causing investors to lose a significant amount of money on that position. A great example of this is the price action we saw on GameStop in early 2021. We saw the stock run up almost 2,000% from around $20 a share all the way up to $350 a share, only to see it revert back to $50 a share within a couple of weeks. The best way of not getting burned by this is by not investing in stocks that have momentum behind it and waiting for that momentum to cool down before you buy into that position. If you do decide to buy into these positions, just be ready to lose a significant portion of your investment. So don't go out there and invest a significant portion of your portfolio into that position. The third mistake all investors should avoid is using past performance to predict future performance. And there's a lot of YouTubers out there, myself included, that'll say things like,
if you invest $100 a week in the S&P 500 that has historically given a 7 to 10% rate of return, you will become a millionaire in 35 years.
Even though everything I said in that statement is completely true, some experts like Kathy Wood, who's the CEO of ARK Invest, believe that future returns on the S&P 500 may not be as great as the returns that we've seen in the past. And the reason for this belief is that the S&P 500 prioritizes profitable companies, and most of the growth that we've seen in the stock market over the past 10 to 20 years have been from companies that have little to no profits. So if these experts are right, that 7 to 10% figure needs to be adjusted down. So anytime you hear performance figures like this, always take them with a grain of salt. And don't bank on that being the return that you'll get in the future. And this leads me into the fourth mistake that I think all investors should avoid, which is taking investment advice from other people, more specifically random people on the internet. When you take investment advice from someone else, it can lead you to making some really poor investment decisions. So let's say you're watching a YouTuber's video, and they say they're going to open position on this very volatile stock. And because you believe in this YouTuber so much, you're going to invest in this position as well. So let's say you decide to buy in, and in a matter of a couple days, the stock loses half of its value. So since your knowledge on this company is very limited, and you have no personal conviction of the stock or the fundamentals behind it, you're a lot more likely to panic sell. And the best way to combat this is being knowledgeable in the fundamentals of whatever you're investing in. YouTube can be a really good place to become aware of new investment opportunities. But it's important that you do your own due diligence before you invest in something, so you can be in the position to make better investment decisions that fit your investment goals. The fifth investment mistake you should avoid is buying assets with poor value. And a good example of this is penny stocks. Investors, and especially newer investors, will buy a stock that's worth $1 per share, and they'll tell themselves, oh, this stock only has to go up 10 cents for me to get a 10% return. And this kind of thinking can be very dangerous. In most cases, there's a reason why a penny stock is valued so low. And this is because the company has very poor fundamentals behind it. And with these kinds of stocks, there's a much higher chance that the stock's going to fall 10% in value than it's going to go up 10% in value. So if you do decide to make these kind of investments, just keep that in mind. So the sixth mistake that should be avoided is putting all of your eggs in one basket and not diversifying. Diversification is very important when it comes to investing. And I'm not going to tell you that you need to diversify into 15 different industries and make sure that no one particular stock is more than 2% of your portfolio or anything like that. But what I will say is that it's not good to have your entire portfolio in just a handful of positions, as by doing this you could expose yourself to massive volatility in these positions. For me personally, I don't like to make one stock more than a quarter of my entire investment portfolio. This ensures that I'm not at the whims of just one stock. And when it comes to diversification, it could be a slippery slope. If you're under diversified, you'd be exposed to more risk. But if you're over diversified, you may not get as great returns as if you were less diversified. So determining a balance of diversification that fits your investment style is very important. And that answer will be different for everyone, so let's keep that in mind. The seventh mistake that all investors should avoid is not tracking their investments. So let's say you go through a process of doing your due diligence on some stocks that you like and you decide to purchase them. And you may be thinking you're done, right? You've already done your due diligence, you're good to go. Now you can just go and buy the stock forever. And that couldn't be further from the truth. Now, since you are invested in these companies, you have to keep tabs on every move that they make to see if the actions by the company still aligns with your investment beliefs. And it's for this particular reason why Warren Buffett believes that if you do decide to buy individual stocks, that you shouldn't own more than 20 stocks at any given time. So remember to keep track of all the investments that you own, whether it's stocks or real estate, to see if there are any fundamental changes that may make you change your investment decisions. The eighth mistake you should avoid is trying to time the market. I've seen so many instances of investors waiting for the market to fall before they buy in, only to see the market continue to run and leave them in the dust. I remember back in late March of 2020, there were so many people telling me that I'm catching a falling knife by buying into that market and that the market will continue to fall. But looking back at it right now, I made the right decision of buying back then because the market has ran ever since then and hasn't looked back since. So the best way to avoid timing the market is by just consistently buying into the market. So every time you get paid, if it's $100, if it's $1,000, doesn't matter. Just take whatever money you plan on investing and put it into the market. And this strategy is called dollar cost averaging. This strategy allows you to take advantage of dips in the market without you trying to time the market. Even though there are many more mistakes that all investors should avoid, these are the 8 most important ones that I thought that were worth mentioning. And by avoiding these mistakes, you'll be on your way to becoming a very successful investor. So I'd like to thank you for watching. So if you enjoyed this video, please hit the like button for your YouTube algorithm. It greatly helps out the channel, helps push this video out to as many people as possible. If you enjoy my perspectives and the way I explain things, consider hitting the subscribe button and notification bell so you get notified anytime I post a new video. Are there any other investment mistakes that you guys commonly make? Let me know in the comment section down below. I'd love to hear from you guys. Also, check out my other socials. I try to post there every day. And thank you so much for watching. I'll see you next video.